As we head into the new trading week, I'm joined on the line now by CMC Markets' Desmond Chua to give us his lowdown on the week ahead. I'm Natty MacDonald and you're watching Dukascopy TV. Desmond, hi. Firstly, are the markets carrying any surprises from the weekend's IMF spring meetings in Washington?
Well, in my opinion, we saw no major surprises from the IMF over the weekend as it concluded that the global economy is recovering, albeit, sounding a bit cautious about an uneven recovery. And in part, the U.S. is poised to do most of the heavy lifting, helping to contribute to a global growth forecast of about 3.6% this year, up from 3% last year. That, however, still falls short of the original growth estimates of 3.7%. But some foreseeable disruptions that could derail this global recovery exist. However, if we do see a political standoff ensue between the West and Russia, that could actually undermine consumer confidence and therefore bring about a slight slackening in global growth.
China watchers will be looking for yet more hints of a slowdown with Wednesday's GDP figure, particularly following Friday's bond auction failure. Where are you pitching this number?
Well, looking at China, I think a couple of economic indicators point towards a softer figure this year. If we were to look into the industrial output, which tends to be a bigger component of GDP, it actually fell in both January and February, pointing at slackening growth. Weaker trade figures as well, with exports falling some 6.6% from a year ago. It's also a concern, and those figures were just out sometime last week. So in terms of domestic consumption and property sales, we are also looking into a slight softening. So, we do think, with all that in mind, GDP may range within the regions of, 7.2% to about 7.3%, which is below the current target of 7.5%.
The IMF's warning to the UK that the British economy is too reliant on people spending money last week seems particularly timely with the release of UK inflation and unemployment data on Tuesday and Wednesday, respectively. Do you agree with the IMF's findings, and what could this consumption reliance mean for the pound?
Well, while I may not, fully agree with the IMF findings, there are indeed some truth to it. If we were to look into the UK trade balance data over the span of last year, we would actually notice a burgeoning deficit, and even as recent as January, exports actually hit a 19-month low. And yet, UK GDP is poised for an uptick this year, largely attributed to faster consumer spending, which accounts for the majority of economic activity in the UK. The risk of this consumption reliance model, however, lies in so-called demographics of the population as well as any domestic political situations, and therefore risk having no outside reliance on exports as well as other capital inflows.
It's a moderate data week for the US with the release of retail sales and inflation data, in addition to 3 scheduled bond auctions. The Nasdaq finished below 4,000 on Friday for the first time since early February, marking its worst week since 2012. What is needed from these reports to boost performance?
I do think, in recent times, fundamentals seem to have taken a back seat or a step back, as more emphasis have been placed on the Q1 earnings season. And we actually saw a paradigm shift from high beta stocks into more defensive sectors due to valuation concerns. That said, however, traders should shift their focus to the U.S. retail sales data for March, as consumer spending is widely expected to rebound after the really bad weather since January. So, judging from the weak performance in equities and the dollar, despite the rise in consumer confidence last week, the retail sales data would have to rise considerably for a change in fortunes, and that said, we are targeting the retail sales data to have to increase beyond expectations of 0.8% for a serious rise in markets.
Desmond, many thanks for your comments. The Dukascopy TV team will be covering all of these events and more, so stay tuned.